right, let's talk about your big, beautiful tax bill that just passed yesterday, July 4th. Happy 4th of July as well. This is the one that's about to show up like an unwanted house guest. Uninvited, loud, and expensive. But what if I told you the IRS gave you a tool to fight back? One that could slash thousands off your taxes this year. It's called Section 199A, and it's one of the most powerful, the most slept on deductions in the entire tax code. I'm not exaggerating. This thing is a freaking monster. And the craziest part is most people, business owners, real estate investors, well, they've never even heard of it. So let's change that. Section 199A is the government's way of saying, hey, buddy, if you're running a business and if you're self-employed, if you're investing in real estate, well, we're going to let you deduct up to 20% of your income right off the top. 20%. No catch. Just some rules you need to understand. So let me take you on a way back machine. All right, this is where this thing came from. Back in 2017, Congress passed the Tax Cuts and Jobs Act. And while everyone was talking about corporate tax cuts, they also threw a bone to the little guy. That bone, well, the Qualified Business Income Deduction, QBI. It was meant to help small business owners and investors compete with giant corporations who only pay 21% in federal income tax. Meanwhile, you as a sole proprietor or LLC, you might be paying up to 37%. Section 199A was designed to level the playing field. Let me show you how it works. And by the way, I'm not a CPA, so please consult that guy your mom told you to go see who's been helping her with her taxes for the past 5 years, or find yourself a new one. So let's say you're running 2 Airbnbs. You clean them, you manage the guests, you handle the bookings, the marketing, the whole thing. Last time I checked, that's a business. So let's say you make $100,000 from those short-term rentals. Under Section 199A, you could deduct $20,000 before taxes even touch your money. So if you're in a 24% bracket, that's $4,800 in tax savings. That is real money, just for understanding how to play the game. Now, here's where most people miss it. This isn't just for retail stores and tech startups. It applies to real estate too, if you're materially participating, not just collecting rent checks. We're talking active management, handling maintenance, marketing your own units, screening tenants, being involved in your operations. If you do that, well, my friend, you're running a business. Here's who can qualify. Sole proprietors, LLCs taxed as sole proprietors, or partnerships and S-corp owners. You need a qualified business income. You need to materially participate. And you need to understand the limitations. The first limitation, your deduction is based on the lower of 20% of your business income or 20% of your taxable income minus capital gains. So if your business makes $100,000, but your taxable income is only $60,000, your deduction maxes out at $12K, not $20K. And again, I am not a CPA, okay? So please go talk to that guy. Still good? But this is why proper planning matters. Here's where it gets a little bit trickier. If you're single and make more than $182,000 or married and make more than $364,100, more rules kick in. Now your deduction is limited by 50% of your W-2 wages or 25% of W-2 wages plus 2.5% of the cost of your business property. And I don't know what the hell all this stuff means, so please talk to that guy who's your CPA. If you don't have W-2 wages, and most real estate investors don't, you're going to rely on that 2.5% of your property basis. So let's say your rental portfolio is worth, I don't know, $800,000. You got no W-2 employees. Well, your limit becomes 25% of zero equals zero plus 2.5% of your $800,000 property value, or $20,000. So even if you made $150,000, your deduction is capped at $20,000. Still a win, but the structure really matters. Well, there's more. If your business is a specified service, trade, or business like law, accounting, medicine, consulting, the deduction phases out entirely once you pass those same income thresholds. But real estate investing, well, that's not a specified service, which means if you're killing it financially, well, you can still qualify. Now let's talk strategy. Smart real estate investors don't just hold properties personally. I know it feels good and looks good on paper. They set up LLCs. They treat their work like a business, and they document material participation. That opens the door to Section 199A. So what the hell is this material participation stuff? Well, let me define it for you. Material participation means you are involved in your business at least 500 hours per year, or you're the main decision maker on a continuous basis. So yeah, if you're mowing lawns, fixing toilets, meeting contractors, well, you're probably good. But if you're just collecting rent checks, you're probably not. And again, that CPA, that's who you want to talk to. Most people miss this deduction because they think it's too complex, or they assume it doesn't apply to them, or they got a CPA who doesn't take the time to dig deep. Please fire that guy. But this isn't some obscure loophole. This is federal law, and it's designed to reward people who build and operate businesses. So here's what I want you to do today. Pull up your tax return, find your qualified business income. Now take 20% of that number. Could be 5K, could be 20K, could be 100,000. That's the money the government is offering you to keep. Do not leave it on the table. And I keep saying this, guys. The wealthy don't win by accident. They win because they know the rules and use them. Section 199A is one of those rules. If you're running a business, managing your own real estate, or investing actively, this is your playbook. Don't let this go over your head. Drop a comment if you want the IRS code translated into English. DM me if you want to strategize your setup. Please talk to a pro who understands the difference between passive income and qualified business income. And if this kind of real talk helps you, well, you know what you need to do. Subscribe. Share this with someone sleeping on free money. And let's stop overpaying taxes together. I'll see you in the next one.